separating reality from fear. VIX expansion separating reality from fear. So selling premium and high implied volatility is ideal because the trader will likely benefit from a volatility contraction. Volatility, as we talked about yesterday and many other times, is mean reverting. So when it goes up, it's at some point, it's going to come down. Sometimes it stays high for a long time, like 2008 to 2009. Stayed high for almost, I want to say, almost 300 days or something. But usually it's 5 or 6 days. And volatility gets high, and then it contracts. But when selling low volatility, there's the risk of implied volatility expansion. That's volatility going up. How serious has this risk been over time? Because we know that volatility goes up. We know when volatility goes up, it goes up really fast. And we know when it comes down, it's like, it could be torture sometimes. But
sure.
How much of a risk is volatility exploding? What do you think? Let's go next slide, and we'll give Tony some more.
I don't know, like on a percentage basis?
Let's give him some. I'm going to give him some more information before I ask.
Content. Yep.
So we're going to look at the SPY. We're going to look at Tesla. The reason we chose Tesla is because of all the stocks that are out there that's consistently been in the top of the most actively traded ones. Like right now, it'd probably be, I think NVIDIA is the most actively traded options.
It's always been the one with some of the most volume.
But Tesla's number 2 right now, and Tesla's always been 1 or 2, I want to say, for the last like 5 years. So we're using SPY and Tesla. They've been 1 and 2 for the longest period of time. We're selling 16 Delta Strangle, 45 days to expiration, managed at 21 days. And we compared when the VIX ranges, when it's below 15, between 15 and 30, which it is right now, and then above 30, which it is a very small percent of the time. In fact, I want to say, based on the research we did yesterday, that I kind of remember that number to be like around 7% of the time. I don't know if that's right, Tony, but I think we're above 30 about 7% of the time. We're between 15 and 30. We're between 15 and 30, probably about 40 to 50% of the time, and then obviously the balance below 50.
In the last calendar year, from February to February, it's probably even less than that. It's only 3 or 4 times in the whole year. Yeah,
but it says BOLO. I'm sorry, BOLOW. Just change that to an E, so we look perfect. Thank you. Let's go next slide. So, for example, when the price of the SPY 16 Delta Strangle will be higher when implied volatility is higher, resulting in a loss seller. Okay, obviously, when volatility goes up, premium sellers lose money. So if implied volatility is 15%, you collect 335. If it's 25%, you collect 505. And if it's 35%, you collect 735. So it's obviously when volatility goes up, proportionally, the amount of premium goes up. The other thing is when you're selling 16 Delta Strangles, when volatility is cheap, you don't make a lot of money. When volatility is expensive, or at least higher, you make money. So that's the most important takeaway from this entire slide. It's that the return on investment is a negative number when volatility is low. That's why we use IV rank to tell us when to get into positions and all that kind of stuff, because we don't do well unless implied volatility is on the higher end of its range. And we're talking about IV. We're talking about straight VIX, but we use IVR to help us with individual stocks to put context around everything. You can see the higher the implied volatility, the better that we do. The buying power, the probability of profit, everything's going to be kind of the same. But the average P&L and the return on investment is better when volatility is higher. Let's go next slide. So to put context around volatility expansion risk, we examine the frequency and the magnitude of expansions. We recorded the VIX on day 1 and day 45 and computed the difference. This was done every trading day since 2017. You can imagine the amount of data in here. This is almost 8 years worth of stuff. Let's go next slide. So for SPY, in very low implied volatility, 75% of the 45-day periods saw a VIX change of less than 3.7 points. So it was fairly rare to see a significant change at the end of the period. Yes, and I think this is the important thing. You can't, and I can't tell you how many times we've stressed this, you cannot time a VIX expansion. That's why it's so difficult to inventory long VIX, because you know at some point it's going higher, but you cannot inventory it because it's untimable. If that's actually
and it's so expensive to hold if your timing is off.
Yeah, you cannot time it.
Mm-hmm.
So what happens here is that you can see that the biggest risk to the upside is when the VIX is below 15, and the least amount of risk to the upside in the VIX is when the VIX is above 30. But again, it's a very difficult thing to time. You have almost no risk. I shouldn't say no risk, but long term, when the VIX is above 30, it contracts. Long term, when the VIX is between 15 and 30, it also contracts. But when the VIX is below 15, it expands. Let's go to the next slide. Even for individual stocks such as Tesla, when the implied volatility is very low, 75% of the 45-day periods experienced a VIX change of less than 3.8 points. Very similar to the SPY, almost a tenth of a point difference. But as a result, the significant changes by the end of these periods were relatively rare. So if you're betting on implied volatility going higher in Tesla, again, it only happens from very low levels of implied volatility. It does not happen when the VIX is above 30. It's interesting to see how close the VIX and the SPY are to each other when you just look at this stuff. Let's go to the next slide. So the other main factors that drive P&L of a short premium trade are delta and theta. Trade P&L often comes from time decay, theta, and from price movement, delta, more than it does volatility. That's a very fair statement. We're volatility sellers, so we're more dependent on volatility contraction. But there's a good little slide. Let's go to the next slide. As shown in our previous studies, selling premium in low implied volatility and low IVR can be profitable, even if it can be minimum, though it's reasonable to mitigate IV expansion. So again, when IV is really low, reduce the number of contracts and overall size and maintain some short delta to offset the Vega risk. The Vega risk is just that volatility expands. And that's mostly going to happen in down moves. Let's go to the last slide.